All right. Hello, everybody. So, pretty ugly day yesterday in the stock market. Here is the SPY, the S&P 500 ETF that we follow. And you can see here that, let's see, go with the laser pointer, right? We had this kind of reversal pattern. We got up to right around 408, and that was the bottom here, and it was the top here. So we can see this a lot in charts, that resistance can convert into support, and support can convert into resistance. And resistance converts into support because of seller's remorse. There are people who sold back here who regret doing so when the market moved higher. They tell themselves, I made a mistake, I'm going to buy my shares back, but only if I can get them for the same price I sold them at. So if we have enough remorseful sellers placing buy orders at the level that they sold at, the level turns from resistance into support. Here we have the opposite, support turning into resistance. This is due to buyer's remorse. We have investors who bought here who regret doing so once the market goes lower, and they tell themselves, I'm going to sell my shares if I get out at break even. So when the market comes back, we have remorseful buyers placing sell orders. And if there's enough of them, the level that was support turns into resistance. And that happens here. So it's a very common phenomenon in charts. If you look at the chart the right way, what you should be looking at is what does it tell you about psychology and supply and demand? So this reversal was pretty nasty. I would think we're probably going to have a little bit of follow through. Notice how this 400 level was kind of important. Resistance, support. A lot of times round levels are, uh, people like to buy and sell at round levels. So a lot of times when we get to a nice round level, there's support or resistance. So different things drive the market at different times. And a big part of yesterday's sell-off was financials. This is the breakdown of the S&P 500. It's 11 different sectors, and we can see the biggest is technology. It's 27 and a half, and the smallest is real estate, 2.66. So these guys aren't really going to have an effect on the broader market, but sometimes energy does. Even though energy is a small percentage, it's an important thing, and people watch it. So we have consumer staples, communication services, industrials, consumer discretionary, financials, healthcare, and then again the tech. So financials were kind of in the driver's seat yesterday. So what I want to do is take a look into the financial sector and figure out how to make money if it keeps going lower. So here we have the financial spider ETF. Now this is an ETF that tracks the financial sector, and we got a big sell-off here. Last time we had a sell-off like this was back here, and you can see there was some continuation. So this is a resistance level. What happens is there's a lot of investors at resistance, right? So resistance is a level where there's more supply than demand. If a market is moving higher, it's because there's not enough supply or sell orders to fill all of the demand or buy orders. So buyers are forced to pay higher prices. Support is the opposite. When a market's going lower, it's because there's not enough demand or buy orders to absorb all of the supply. So anyway, when we're at these resistance levels, investors start to get a sense that there are other sellers lurking around. That's why the market's not moving any higher. So say they're trading at 36. Someone might say, it's trading at 36, but I think another seller's coming into the crowd here. It seems like the buyers are fading. I better reduce my price that I want to sell my shares at, or I might miss it. If I'm not offering the shares at the lowest price, someone who wants to buy it is just going to go to someone else. So they might go to 35.90. The next person might say, hey, someone's at 35.90. All right, well, I don't want to miss it, so I'm going to go to 39.85, and so forth and so on. And it creates this snowball effect. And that's what drove us down. And we got below these prior lows. So this is some pretty weak action. I think there should probably be some follow through. Now, just like the S&P is made up of different sectors, the sectors are made up of different industries. And these are the industries in the financial sector: banks, capital markets, insurance, diversified financial services, and consumer finance. Now, there's ETFs that track some of these. So if we want to get insight into what's going on in the financial sector, we can look at the financial industries, and it gives us a little bit of insight. For example, it's analogous to if we want to know what's going to happen with the S&P 500, it's a good idea to follow the sectors because, like I said before, different sectors are in the driver's seat at different times, and we can get signals from them. So Let's look at some of these. This is the ETF that tracks banks, KBE. Now, again, when there's not enough supply to fill all the demand, the buyers are forced to pay higher prices, and this forces the uptrend. When we get to resistance, all of a sudden there is enough supply to fill all the demand, and sellers start to get anxious. They think they're going to miss it, and then we get the reversal. Now, if we get down here to the support level, well, there's a good chance that we bounce. It's the same kind of thing, right? Investors want to buy, and they get the sense that there are other buyers around, which is why the price isn't moving any lower. And they tell themselves, I'm going to buy my shares. I don't want to miss it, so I'm going to have to step up a little. So instead of paying 44, I'm going to pay 44.10. Someone else says I'm going to pay 44.20, and we get the snowball effect. Now, this illustrates a pretty important principle here, which is a relatively easy thing to trade. This down here is the relative strength index. This measures momentum. And momentum measures how far something has moved from time point A to time point B. Most of the time, something is trading within its typical range, right? That's why it's called its typical range. If we get below that range, we call that oversold. And if we get above that range, we call that overbought. Now, why is this important? Well, markets that are overbought or oversold tend to reverse. A lot of trading strategies on Wall Street are based on this concept of reversion to the mean. So this is a basic principle. Markets that are oversold, see when this blue line is below this red line, it indicates oversold conditions. And when it's above it, it indicates overbought conditions. So oversold markets, oversold, that get to support here, tend to bounce. Now, a lot of times a support or a resistance level that's important can retain its importance for a while. We call this market memory. Notice how this resistance here, this resistance here. So also, another principle is overbought markets that get to resistance tend to sell off. And that's exactly what happened here. So just remember that oversold markets that get to support tend to bounce. Overbought markets that get to resistance tend to sell off. Again, this is our bank industry. Here's our insurance industry. This has had a pretty nasty sell-off here. So we can see that this was support. I'm trying to get my pen up here. So this is support, right? There's enough buyers to fill all of the demand. Now notice how the resistance converted into support. That's our seller's remorse again. Now, when a support level breaks, sometimes we get big moves like this. And that's because it tells us something. If the price is below the support level, it tells us that the investors who created the support with their buy orders have left the market. Anytime you pull demand or buyers out of a market, it sets the stage for the price to go lower because the sellers will need to offer their shares out at a discount, and that forces a downtrend. And the same thing happens with resistance. If we clear the sellers out of the way, then there's a good chance that the buyers have to take it up to get their orders completed. But this looks pretty weak, but if it keeps going, I would look for support down around here. This is our regional banking ETF, and we can see some of the same principles here. We've got oversold. Come on. Got oversold. At the same time, we've got to support. And what happened? We bounced. Remember, oversold markets that get to support tend to bounce. Now here we have overbought. And it's not a perfect level, but we can see there's resistance there. So I'd be watching this. If it gets down to 57, there's a good chance it bounces. Now, just like we're looking in the industries to get an idea of what the sector is going to do, if we want to, I don't have the time to do it today, but we'll certainly do it in future lessons. We could look within the industry to see what stocks are in it and get ideas. Like, for example, this ETF is the aggregate of the sector. Okay, so just by definition, there are going to be things in here that look worse, that have sold off more, that are more oversold, and we can see we're almost oversold here. And we're going to have things that look better, things that look like they're not as oversold or not as down as much. So by doing that, we can get some ideas. Like for example, maybe there are some regional bank stocks right now that are really oversold that are out support that might bounce. So we will talk about that in a future date. Here's our capital markets ETF, and once again, we see this clear concept of some price levels are more important than others. So resistance back here became support here. So if this support breaks, there's a good chance we get a rapid move lower. Now, let's see here. This is what we call an inverse ETF. Now, notice how, despite the fact that the market was so weak yesterday, this thing was up 7.6%. This is designed to trade 3 times inversely to the financial sector. So if the financial sector keeps going down, this thing is going to skyrocket. So it's important to understand that even if you're not an options or a futures trader, there are ways that you can make money when the market is going down. And that's something we talk a lot about here at Stock Market Jobber. Now you got to be careful because if you're wrong, it's going to go you're going to lose your money 3 times as fast. But if you're right, it's a great way to get some leverage and some exposure. All right, everyone, thank you so much, and I will talk to you soon.